Here's a mind-blowing fact. If you had invested $1 million in the S&P 500 instead of using it to buy a house outright 10 years ago, you'd have earned roughly $700,000 more than what you'd have paid in mortgage interest. This is exactly why billionaires like Mark Zuckerberg choose mortgages. It's called investment arbitrage, borrowing at 3 to 6% while earning 7 to 10% elsewhere. And it's just one of the financial strategies I'm breaking down today that help the ultra-wealthy get even richer. Stick around to learn how you can apply these same principles to your own finances, even without billions in the bank. The Zuckerberg paradox. Why a billionaire chooses to borrow. Did you know Mark Zuckerberg, worth over $100 billion, has a $6 million mortgage on his home? This might sound completely crazy. Why would one of the richest people on the planet choose to borrow money and pay interest when he could easily write a check for the full amount? Let's unpack this financial paradox that reveals a lot about how the ultra-wealthy think about money. Back in 2012, Zuckerberg made a fascinating financial move. He refinanced his Palo Alto home with a 30-year mortgage at an incredibly low interest rate of just 1.05%. This wasn't some mansion he couldn't afford. It was a relatively modest $6 million property for someone of his wealth. At the time, Facebook was already a massive success, and Zuck was sitting on billions in company stock. So what gives? Why would someone who could buy dozens of these homes with cash choose to make monthly payments to a bank? The answer reveals the first major lesson in billionaire money management: opportunity cost. For billionaires like Zuckerberg, cash isn't just something you use to buy stuff. It's ammunition for building more wealth. Every dollar tied up in a paid-off house is a dollar that's not working to make more money elsewhere. And when you have billions, those opportunities add up fast. Let's run the numbers on Zuckerberg's decision. By taking out that $6 million mortgage at 1.05%, he was paying roughly $63,000 in interest annually. That might sound like a lot to you or me, but here's where it gets interesting. During the decade after this mortgage decision, Facebook stock grew by approximately 800%. Had he liquidated $6 million worth of Facebook shares to buy the house outright in 2012, those same shares would have been worth around $48 million by 2022. The math is pretty compelling. Pay $63,000 per year in interest, or miss out on $42 million in potential gains. Even after accounting for the total interest paid over that period, Zuckerberg's decision to keep his money in Facebook stock instead of paying cash for his house generated tens of millions in additional wealth. This isn't just a lucky break from rising stock prices. It's a deliberate wealth-building strategy that billionaires use called investment arbitrage. At its core, investment arbitrage means borrowing money at a lower rate and then investing it where you can earn higher returns. It's like a financial magic trick where you're making money on someone else's money. While most people focus on eliminating debt, the wealthy see certain types of debt, especially low-interest mortgages, as valuable tools for wealth creation. When Zuckerberg can borrow at 1.05%, but earn substantially higher returns by keeping his money in Facebook stock, that gap between what he pays in interest and what he earns in investments becomes essentially free money. Of course, this strategy isn't without risks. If Facebook stock had tanked instead of soared, the math would look very different. But billionaires have two advantages here. First, they typically have diversified investments that mitigate some of this risk, and second, they have enough wealth to weather potential downturns without jeopardizing their financial security. What's particularly clever about Zuckerberg's mortgage is the timing. He locked in that 1.05% rate during a period of historically low interest rates. That's another billionaire move, taking full advantage of market conditions to secure money at rates below inflation. When inflation runs higher than your mortgage rate, you're essentially being paid to borrow money, as the real value of your debt decreases over time. So while most people celebrate paying off their mortgage, billionaires like Zuckerberg are calculating how to keep that cheap money working for them as long as possible. When you can borrow at 1 to 6% and invest with expectations of earning 7 to 12% or more, the math favors keeping the mortgage. There's another layer to Zuckerberg's decision that's worth noting. By taking out a mortgage instead of liquidating Facebook shares, he maintained his ownership stake and voting power in the company he founded. For tech founders like Zuckerberg, maintaining control of their companies is often more important than having a paid-off home. The benefits of this approach extend beyond just the raw investment returns. There are tax advantages too. Mortgage interest is potentially tax-deductible up to certain limits, which means the actual cost of borrowing is even lower than the stated interest rate. Meanwhile, as long as Zuckerberg holds his Facebook shares without selling, he doesn't pay capital gains taxes on their appreciation. This combination, low-cost borrowing, tax advantages, and keeping money invested in high-growth assets, creates a wealth acceleration framework that most Americans never learn about. Traditional financial advice often focuses on debt reduction above all else, but billionaires recognize that strategic borrowing can actually build wealth faster than paying cash. It's worth noting that this strategy works best when you have investments that reliably outperform your borrowing costs. For Zuckerberg, Facebook stock was that vehicle. For other wealthy individuals, it might be a diversified investment portfolio, real estate holdings, or business investments. The billionaire approach to mortgages isn't just about mathematical optimization, though. It's also about liquidity and flexibility. By keeping more cash available rather than tying it up in real estate, the wealthy maintain financial agility, the ability to quickly capitalize on new opportunities or weather unexpected challenges without selling assets at inopportune times. Think about it this way. If a lucrative investment opportunity suddenly appeared, would you rather have your money tied up in your house's equity or available to deploy? Billionaires almost always choose flexibility and opportunity over the psychological comfort of debt freedom. What's really fascinating about Zuckerberg's mortgage strategy is that it contradicts much of what we're taught about financial success. The conventional wisdom tells us that debt is bad, paying off your house is good, and the path to wealth is becoming debt-free as quickly as possible. But the actions of the world's wealthiest people tell a different story. One where certain kinds of debt, used strategically, become accelerants for wealth creation rather than obstacles to it. Of course, there's an important distinction to make here. The type of debt matters enormously. High-interest consumer debt for depreciating assets or consumption is indeed wealth-destroying. But low-interest debt for appreciating assets or investments can be wealth-building when used properly. Billionaires ruthlessly avoid the former while strategically leveraging the latter. The mortgage strategy used by Zuckerberg and other billionaires reveals a fundamental truth about wealth creation. It's not just about how much you earn, but how effectively you deploy what you have. By using other people's money, in this case the banks, to keep more of their own capital working in higher return investments, the ultra-wealthy turn leverage into a wealth multiplication tool. Elon's $50 million borrowing spree, the Tesla stock protection plan. If leveraging other people's money is a wealth multiplication tool, then Elon Musk might just be the ultimate power user. In 2018, during a make-or-break period for Tesla, Musk quietly secured $61 million in mortgages across 5 California properties. But the real genius wasn't in the borrowing itself. It was in what he avoided by not touching his Tesla shares. Picture this. It's 2018, Tesla stock is riding a roller coaster of volatility, and Elon Musk wants to expand his real estate portfolio with several luxury properties in California, including a mansion in Bel Air. Most people would assume a billionaire would just write a check and be done with it. But Musk had something much more valuable to protect, his Tesla stock position. Why would someone who could easily afford these properties in cash choose to tie himself to massive monthly payments? The answer reveals a masterclass in wealth preservation during uncertainty. Let's break down what was happening with Tesla at the time. The company was experiencing extreme stock volatility, some days up, some days crashing down. Investors were constantly analyzing Musk's every move for signals about the company's future. In this pressure cooker environment, Musk needed to acquire several high-end properties without sending the wrong message to the market. If Musk had sold Tesla shares to cover his $61 million real estate shopping spree, he would have triggered a financial chain reaction that could have been catastrophic. First, he would have faced substantial capital gains taxes, potentially millions of dollars gone in an instant, with the capital gains tax rate for high-income earners reaching up to 20%. That's a massive financial hit just to pay for houses. But the tax bill would have been just the beginning of his problems. The real danger was the message a stock sale would have sent to investors. Imagine the headlines. Musk dumps Tesla shares to buy mansions. The market would have interpreted this as a lack of confidence in Tesla's future, potentially, triggering a selling panic among other investors. During this critical period for Tesla, Maintaining his position as the company's largest shareholder wasn't just about personal wealth, it was about control. Every share Musk holds gives him voting power in company decisions. Selling even a portion of his stake would have diluted his influence at a time when he needed maximum control to guide the company through turbulent waters. So instead of selling shares, Musk did what the ultra-wealthy often do: he borrowed. By securing mortgages on his properties, he maintained his full equity position in Tesla, avoided capital gains taxes entirely, and kept his voting power intact, all while still acquiring the properties he wanted. This strategy paid off in spectacular fashion. While Musk was paying roughly 4.7% interest on his mortgages, Tesla stock went on an absolute tear in the years that followed. From 2018 to 2022, Tesla stock saw an average annual growth rate exceeding 40%, dwarfing the cost of his mortgage interest. Think about that gap for a second. Borrowing at under 5% while his investment was growing at over 40% annually. That's not just smart money management. That's financial wizardry that created exponential wealth. Had Musk sold Tesla shares in 2018 to buy those properties outright, he would have missed out on the massive growth those shares experienced in the following years. Musk himself has openly acknowledged this strategy. In public statements, he's indicated that he prefers borrowing against his assets rather than selling them. This approach allows him to maintain his investment positions and sidestep the tax implications of selling, a perfect example of thinking several moves ahead on the financial chessboard. The strategy also perfectly demonstrates the principle of liquidity management. By using other people's money, in this case the banks, Musk preserved his own liquidity for other potential opportunities and emergencies. During uncertain times, cash flexibility can be just as valuable as investment growth. What's particularly brilliant about Musk's approach is how he used debt as a protective shield for his most valuable asset, his Tesla stock. While conventional financial wisdom often portrays debt as a vulnerability, Musk transformed it into a defensive tool that actually protected his wealth during a period of market uncertainty. This borrowing strategy also highlights a fundamental difference in how the ultra-wealthy view their assets compared to average homeowners. For most people, their home is their primary asset. For billionaires like Musk, their homes, even $61 million worth of them, are just a small piece of their wealth pie. Their true wealth engine is their business ownership, making it logical to protect those assets at all costs, even if it means taking on significant real estate debt. When we look closer at the numbers, the brilliance becomes even clearer. If Musk had sold Tesla shares in 2018 and paid the 20% capital gains tax, he would have needed to sell substantially more than $61 million in stock to cover both the properties and the tax bill. Every dollar of Tesla stock he would have sold then would be worth multiple dollars today. A compound loss that could easily total hundreds of millions or even billions in today's valuation. Instead, by holding onto those shares through strategic borrowing, Musk protected his position during Tesla's most critical growth phase. The company went from struggling to meet production targets to becoming one of the most valuable companies in the world. His decision to borrow rather than sell preserved his stake in this extraordinary success story. For anyone looking at this strategy from the outside, there's an important lesson. The wealthy don't just focus on acquiring assets. They're equally focused on how to protect and preserve what they already have. Sometimes taking on debt is actually the most conservative move when it protects a high-growth asset from taxation and market signal risks. This isn't just about having access to massive loans that regular people can't get. It's about recognizing the strategic value of different types of assets and making decisions that prioritize long-term wealth growth over short-term convenience. Musk's mortgage strategy exemplifies the buy, borrow, die approach that we'll dive into more deeply later. By borrowing against assets rather than selling them, wealthy individuals can access cash without triggering taxable events, keeping their wealth-generating engines running at full capacity. Beyoncé and Jay-Z's $52 million mortgage masterclass, the inflation shield. What if I told you that Beyoncé and Jay-Z's $52.8 million mortgage wasn't just a loan, but a carefully calculated wealth-building strategy? While Elon Musk was playing defense with his borrowing tactics, music's billion-dollar power couple was positioning themselves for an economic phenomenon that would make their seemingly expensive mortgage look like financial genius years later. When Beyoncé and Jay-Z dropped $35 million as a down payment on their $88 million Bel Air mansion in 2017, financial experts were scratching their heads. Why would two superstars with a combined net worth well over $1 billion choose to finance over half the purchase price? They could have easily written a check for the full amount and avoided paying around $1.8 million in annual interest payments. But here's where their financial acumen really shines. The Carters secured their massive mortgage at a fixed 3.4% interest rate, a rate that would prove to be pure financial gold just a few years later. Let's break down what actually happened after they signed those mortgage papers. In 2021 and 2022, something dramatic happened in the U.S. economy. Inflation skyrocketed to levels we hadn't seen in decades. While most Americans were feeling the painful squeeze of rising prices, Beyoncé and Jay-Z were quietly benefiting from their 2017 decision. With inflation rates hitting between 7 to 9% in 2022, their fixed 3.4% mortgage suddenly became a money-making machine in disguise. How? When inflation outpaces your fixed interest rate, you're essentially getting paid to borrow money. It sounds counterintuitive, but it's true financial mathematics. Think about it this way. The Carters locked in their obligation to pay back dollars at a 3.4% premium. But when inflation hit more than double that rate, the actual dollars they were using to make their payments had lost significant purchasing power. They were paying back their debt with cheaper money than what they borrowed. Let me put this in perspective. That $52.8 million they borrowed in 2017 is worth substantially less in today's inflation-adjusted dollars. While they're still paying the same dollar amount each month, the real value of that debt has been quietly eroding year after year. It's like getting a discount on your debt without having to negotiate. Meanwhile, the Bel Air real estate market has been booming. Luxury properties in that area have seen significant appreciation, with home prices increasing approximately 5.3% from March 2023 to March 2024 alone. This appreciation has likely been happening since their 2017 purchase, meaning their asset is growing in value while their debt is shrinking in real terms. But the genius doesn't stop there. Remember that $35 million they didn't sink into the property? That money wasn't sitting idle in a checking account. The power couple has diverse business interests spanning entertainment, fashion, and other investments. By keeping that money working in their various business ventures and investments, they've likely seen returns that far outpace the 3.4% they're paying on their mortgage. Both Beyoncé and Jay-Z have expanded their business empires significantly since 2017. Beyoncé has her Ivy Park athleisure line and numerous other ventures, while Jay-Z has his entertainment company Roc Nation, streaming service Tidal, and various other investments. These business endeavors have almost certainly generated returns well above their mortgage rate, creating a positive cash flow situation. This is precisely why billionaires love mortgages during inflationary periods. Fixed-rate mortgages act as an inflation hedge, a financial shield that actually benefits the borrower when prices rise rapidly. While inflation erodes the purchasing power of cash savings, it simultaneously makes debt less burdensome. Your mortgage payment stays the same, but the relative cost of that payment compared to your income and asset values decreases. The ultra-wealthy understand something that many regular homeowners don't. Inflation is the enemy of cash and the friend of debt. Cash sitting in your bank account loses purchasing power when inflation is high. But debt, particularly fixed-rate debt tied to appreciating assets, actually becomes less expensive in real terms. Let's run some quick numbers to illustrate this point. If inflation averages just 4% annually, which is lower than what we've seen recently, the purchasing power of a dollar decreases by about 34% over 10 years. That means the $52.8 million debt the Carters took on in 2017 would effectively be worth only about $35 million in 2027 dollars. They're getting a $17.8 million discount just by waiting and letting inflation do its work. And this isn't even accounting for the years when inflation spiked well above 4%. During those periods, the erosion of their debt value accelerated even faster. There's another aspect of their strategy that deserves attention: cash flow flexibility. By maintaining liquidity instead of tying up all their cash in their mansion, Beyoncé and Jay-Z preserved their ability to jump on other investment opportunities as they arose. When you're running business empires that span multiple industries, having capital available to deploy quickly can be the difference between seizing or missing lucrative opportunities. Consider the timing as well. In 2017, few economists were predicting the massive inflation spike that would hit just a few years later. The Carters either had incredible foresight, or more likely, they understood that over a long enough time horizon, some inflation is virtually guaranteed. By securing a fixed-rate mortgage, they were positioning themselves to benefit regardless of when that inflation arrived. This strategy is particularly powerful because it doesn't require active management. Unlike stock investments that might need constant attention and adjustment, their inflation hedge works automatically in the background. They simply make their mortgage payments as scheduled, while inflation silently reduces the real burden of their debt year after year. It's important to note that this strategy isn't just for billionaires. Homeowners of all financial levels can benefit from the inflation hedging properties of fixed-rate mortgages. While most of us aren't buying $88 million mansions, the same principles apply to more modest homes. A fixed-rate mortgage on any appreciating property can provide similar protection against inflation's erosive effects. The Carter-Knowles approach represents a sophisticated understanding of how money works over time. They recognize that debt, when used strategically on appreciating assets and combined with smart investments elsewhere, can be a powerful wealth-building tool. They weren't just buying a luxury mansion. They were implementing a financial strategy that would continue paying dividends for years to come. Their mortgage decision stands in stark contrast to the conventional wisdom that prioritizes being debt-free above all else. The Carters understood that certain types of debt, particularly low-interest, fixed-rate debt secured by appreciating assets, can actually accelerate wealth building rather than hinder it. So the next time you hear financial gurus preaching that all debt is bad, remember Beyonce and Jay-Z's $52.8 million mortgage masterclass. Sometimes, the smartest financial move isn't paying cash. It's leveraging other people's money in a way borrow, die, the ultimate billionaire wealth preservation strategy. That strategic borrowing you just learned about? It's actually part of a shocking wealth preservation system that billionaires have perfected over generations. Imagine building a fortune worth billions while legally avoiding income taxes almost entirely. This isn't some secret conspiracy theory. It's a documented strategy with a simple name: buy, borrow, die. This three-word wealth preservation formula wasn't created in some shadowy billionaire conference room. It was actually identified and named by USC tax law professor Edward McCaffrey back in the 1990s. McCaffrey coined this term specifically to explain how the ultra-wealthy navigate around our tax system in perfectly legal ways. As McCaffrey himself noted, once you're already rich, it's simple, it's easy. It's just buy, borrow, die. These are planks of the law that have been in place for 100 years. Think about that for a moment. These tax advantages aren't new loopholes. They've been baked into our financial system for a century. So how does this strategy work? Let's break down each step of this billionaire wealth hack and see why it's so incredibly powerful. Step 1. By appreciating assets. This is the foundation of all serious wealth building. While most of us work for a paycheck and pay income taxes with each deposit, billionaires focus on acquiring assets that grow in value over time: stocks, real estate, private businesses, art collections, anything with serious growth potential. The key insight here is that simply owning these assets as they appreciate in value doesn't trigger any taxes. You don't pay taxes when your stock portfolio doubles in value or when your commercial real estate appreciates. You only pay when you sell. And billionaires? They rarely sell. Which brings us to step 2. Borrow against those assets. This is where the magic really happens. Instead of selling assets and triggering capital gains taxes, billionaires use their growing portfolio as collateral for loans. Need $10 million for a new yacht? No problem. Just take out a loan against your $500 million stock portfolio. Here's the tax genius at work. Loan proceeds aren't considered income. When you borrow money, even billions of dollars, the IRS doesn't consider that taxable income. It's debt, not earnings. So while most Americans pay 22%, 32%, or even 37% income tax on their paychecks, billionaires can access enormous sums of cash without paying a penny in income tax. The banks are more than happy to play their part in this arrangement. They eagerly offer these loans at favorable interest rates because they're secured by massive asset portfolios. The risk to the bank is minimal. If the billionaire doesn't repay, which is unlikely, the bank simply takes a portion of the collateralized assets. Now for the final, most controversial step, die. I know it sounds morbid, but from a tax perspective, it's brilliant. When someone passes away, their heirs receive assets with what's called a stepped-up basis. This is the crown jewel of wealth preservation strategies. Here's how it works. Let's say a billionaire bought $10 million worth of stock decades ago, and by the time they pass away, it's worth $1 billion. If they had sold that stock during their lifetime, they would have owed capital gains tax on the $990 million in appreciation. But when heirs inherit these assets, the tax code says the new basis becomes the market value on the date of death, $1 billion in our example. All that appreciation that occurred during the billionaire's lifetime, the tax liability completely vanishes. Poof, gone. The heirs could sell everything the day after inheritance and pay zero capital gains tax. So through this three-step cycle, a billionaire can build enormous wealth, live a lavish lifestyle funded by tax-free loans, and then pass their fortune to the next generation with the slate wiped clean of capital gains tax liability. Wash, rinse, repeat across generations, and you have a tax-free dynasty. According to estimates, this strategy and others like it result in billions of dollars in lost tax revenue annually. The money that would otherwise fund public services instead remains in private family fortunes, compounding over generations. You might be thinking, this can't be right. Surely billionaires pay some taxes. While they may pay property taxes and sales taxes like everyone else, many of the ultra-wealthy pay surprisingly little in income tax relative to their wealth growth. By avoiding selling assets and instead borrowing against them, they can maintain incredible lifestyles without triggering the taxable events that would lead to significant income tax bills. The buy, borrow, die strategy isn't just theoretical. We've seen it at work in the case studies we've examined. Remember how these billionaires all opted for mortgages despite having plenty of cash? That's because selling assets to buy properties outright would trigger capital gains taxes and interrupt their wealth-building momentum. This strategy also explains why banks offer such favorable terms to ultra-wealthy clients. The loans are critical components of the billionaire's tax strategy, and banks compete aggressively to provide this service, knowing the loans are well secured and part of a long-term wealth management relationship. What's particularly fascinating is that this approach isn't limited to the ultra-wealthy. While you might not have billions in assets, the principles can be adapted for more modest portfolios. Anyone with appreciating assets can begin implementing scaled-down versions of this strategy, building a portfolio of growing assets, strategically borrowing against them when needed, and understanding the inheritance tax benefits available under current law. Tax experts note that by leveraging assets for loans instead of selling them, individuals at various wealth levels can maintain liquidity while avoiding tax implications that would otherwise slow their wealth-building momentum. It's essentially creating your own tax-free income stream through strategic borrowing. Of course, this strategy has come under increased scrutiny in recent years. Proposed legislation, like Senator Elizabeth Warren's wealth tax, specifically aims to address these tax avoidance strategies employed by billionaires. These reforms could potentially close some of the loopholes that allow for the buy, borrow, die approach to work so effectively. The debate around this strategy highlights a fundamental tension in our tax system. It's designed primarily to tax income, not wealth, and that distinction creates the opening that allows billionaires to legally minimize their tax burdens through strategic financial planning. What makes this strategy so powerful is that it compiles multiple tax advantages into one cohesive system. Each element, asset appreciation without taxation, tax-free loan proceeds, and the stepped-up basis at death, is individually powerful. Combined into one strategy, they create an almost impenetrable tax shelter that allows wealth to grow exponentially over generations. For most Americans who earn paychecks, pay income taxes, and struggle to save for retirement, this strategy can seem unfair. They're paying taxes on every dollar they earn while watching billionaires grow their fortunes with minimal taxation. But rather than just feeling frustrated, understanding how the system works allows us to make more informed financial and voting decisions. Some financial advisors argue that aspects of this strategy can be adapted by middle-class investors. While you might not be borrowing millions against your stock portfolio, understanding the tax implications of selling versus borrowing can inform smarter financial moves. especially around major purchases or investment opportunities. The bank's perspective: why lenders love wealthy borrowers. Financial institutions aren't exactly known for their generosity, yet they offer billionaires interest rates that would make the average homebuyer green with envy. What makes the ultra-wealthy such attractive borrowers that banks will slash their profits just to win their business? This seemingly backward approach isn't charity. It's actually one of banking's most profitable strategies. When you apply for a mortgage, you're hit with a barrage of requirements: proof of income, credit checks, debt-to-income ratios, and more. You're essentially trying to convince the bank you won't default. But for billionaires, the red carpet rolls out automatically. Think about it. When someone with $10 billion in assets wants to borrow $50 million for a mansion, the math becomes incredibly simple for banks. There's virtually zero chance that loan won't be repaid. Even if the billionaire's primary business crashed overnight, they'd still have more than enough assets to cover that loan several times over. This incredibly low-risk profile creates what financial institutions consider the holy grail of banking: guaranteed income with almost no possibility of loss. It's like finding a money printer that never breaks down. For banks, these loans represent pure profit machines, steady interest payments flowing in month after month with minimal resources needed to monitor or manage the relationship. But it gets even better for banks. The wealth management departments at major financial institutions have made loans totaling over $600 billion to ultra-high net worth clients. That's not just pocket change. It's a significant portion of their total loan books, creating a massive revenue stream that flows like clockwork. The statistics back this up too. High net worth borrowers have substantially lower default rates compared to average borrowers. While typical mortgage default rates might hover around 1 to 2% in normal economic conditions, the default rate for ultra-wealthy clients approaches zero. From a risk management perspective, these loans are as close to perfect as banking gets. So what does this mean in practical terms? Banks offer the ultra-wealthy significantly better loan terms, interest rates that are often 1 to 2% lower than what regular folks can access. If you're getting a conventional mortgage at 6%, a billionaire might be paying just 4% for the same type of loan. And the special treatment doesn't stop at interest rates. Ultra-high net worth individuals can negotiate jaw-dropping terms that wouldn't even be on the menu for regular customers. Want interest-only payments for 5 years? No problem. Need a flexible repayment schedule that accommodates your business cash flows? Consider it done. Want to skip a few payments when you're buying that private island? They can probably work something out. Major financial institutions have actually created entire specialized banking divisions that focus exclusively on catering to ultra-high net worth individuals. These aren't just regular bank branches with fancier coffee. They're completely separate operations with dedicated teams of professionals whose sole purpose is designing custom mortgage products that meet the unique financial needs of the super-rich. Another interesting aspect is how banks handle jumbo loans, mortgages that exceed the conforming loan limits set by Fannie Mae and Freddie Mac. These jumbo loans, frequently used by wealthy clients, typically have different underwriting standards altogether. While you might expect larger loans to come with stricter requirements, the opposite often happens for the ultra-wealthy. The standards become more flexible, and the terms more favorable. There's also a strategic element for banks beyond just the mortgage itself. These loans serve as relationship-building tools. When a bank secures a $50 million mortgage with a billionaire, they're not just getting the interest payments. They're opening the door to managing that person's investments, handling their business accounts, financing their companies, and providing wealth management services across generations. This relationship angle explains why banks sometimes appear to compete almost desperately for these high net worth clients, even offering terms that seem barely profitable on the surface. The mortgage might be the entry point, but the real prize is everything else the billionaire brings to the table. Consider what happens when a bank lands a client like Beyonce and Jay-Z. Beyond their mortgage, there's potential to handle their business ventures, investment portfolios, and even their philanthropic endeavors. One mortgage can blossom into dozens of profitable banking relationships across their entire financial empire. The stark difference in treatment becomes even more apparent when you look at how banks market to different customer segments. For average borrowers, the focus is on qualifying you for a loan. For the ultra-wealthy, it's about outcompeting other banks with white-glove service and customized solutions. Some financial institutions have created invitation-only banking services where relationship managers handle every aspect of a wealthy client's financial life. These elite banking units operate more like concierge services than traditional bank branches. Need financing for a $30 million yacht while vacationing in Monaco? Your dedicated banker is just a phone call away, ready to make it happen before your champagne gets warm. This two-tier system in banking creates what some critics call a wealth feedback loop. The wealthier you are, the better terms you get, which makes it easier to preserve and grow your wealth, which then qualifies you for even better terms in the future. Meanwhile, those with less wealth pay higher interest rates, making wealth building through leverage more challenging. It's not just about the risk profile either. There's also an efficiency component for banks. Processing a $50 million mortgage for one billionaire requires far fewer resources than processing $51 million mortgages for upper-middle-class borrowers. The paperwork, underwriting, and servicing costs per dollar loaned are dramatically lower. The banking industry's preference for ultra-wealthy clients also explains why banks have shifted significant resources toward expanding their wealth management divisions. Traditional retail banking simply can't compete with the profit margins and stability offered by catering to billionaires. For the average person observing this system, it might seem profoundly unfair. Those with the least need for financial breaks get the biggest discounts. But from the cold, calculating perspective of banking economics, it makes perfect business sense. Banks aren't charities. They're profit-seeking enterprises that naturally gravitate toward the most profitable, least risky customers. Understanding this dynamic gives us insight into why billionaires are so comfortable carrying large mortgages. They're getting deals that most of us can only dream about, with terms tailored specifically to their wealth preservation strategies. When banks are practically begging to lend you money at rock-bottom rates, why wouldn't you take advantage? This special treatment extends beyond just interest rates and into the structural aspects of loans as well. While most homeowners are limited to standard 15 or 30-year fixed-rate mortgages, the ultra-wealthy can access creative financing solutions that might include adjustable components, balloon payments, or even foreign currency options that align with their global financial positions. The combination of minimal default risk, relationship potential, and operational efficiency creates a perfect storm of incentives for banks to court wealthy borrowers aggressively. Far from being a quirky anomaly in banking, this preferential treatment for billionaires has become a cornerstone of modern financial institutions' profit strategies. The tax-advantaged triple play: deductions, deferrals, and discounts. Banks aren't the only ones giving billionaires preferential treatment. Uncle Sam is quietly offering them a financial buffet through the tax code. When it comes to mortgages, there's actually a three-part tax advantage system most homeowners never fully leverage. While you might know about one benefit, the real wealth-building magic happens when all three work together. The first advantage in this tax triple play is the mortgage interest deduction, but it's undergone some significant changes in recent years. Under current tax law, you can deduct interest paid on mortgages up to $750,000 for loans taken after December 15, 2017. If you locked in your loan before that date, you're grandfathered into the previous $1 million limit. This change was part of the Tax Cuts and Jobs Act of 2017, which dramatically reshaped how homeowners benefit from their mortgages. But here's something most homeowners don't realize. This deduction is becoming less valuable for the average American. Why? The same tax law nearly doubled the standard deduction, which means fewer people find it worthwhile to itemize their deductions. Statistics show that in just 1 year after the new tax law, the number of taxpayers claiming the mortgage interest deduction plummeted by 40%. Out of nearly 143 million taxpayers, only about 16.46 million claimed this deduction following the tax changes. For billionaires, this shift barely registers as an inconvenience. Their mortgage interest is typically just one small piece of a much larger itemized deduction strategy that easily exceeds the standard deduction threshold. Meanwhile, most middle-class homeowners are now better off taking the standard deduction, effectively losing the tax benefit of their mortgage interest payments. The second advantage is what I call tax-deferred investment growth. When you tie up your money in a paid-off house, that capital can't work for you elsewhere. By maintaining a mortgage and keeping your money invested instead, you create a powerful tax deferral machine. Your investment gains can compound for years or even decades without triggering immediate tax consequences. This is where billionaires truly excel. They understand that $1 of tax deferred is better than $1 of tax saved today because of the time value of money. By keeping their capital deployed in investments rather than paying off mortgages, they essentially receive an interest-free loan from the government in the form of deferred taxes. These investments grow tax-free until they're sold, creating a snowball effect that dramatically accelerates wealth building. The third advantage, which rarely gets the attention it deserves, is the capital gains exclusion on home sales. Homeowners can exclude up to $500,000 in capital gains from the sale of their primary residence, $250,000 for single filers, if they've lived in the home for at least 2 of the past 5 years. This is an extraordinary benefit hiding in plain sight. Think about it. Most investments get taxed when you sell them at a profit. Your stocks, taxed. Your Bitcoin, taxed. Your rental property, definitely taxed. But your primary residence gets this special $500,000 exclusion that essentially makes a huge chunk of your real estate profits completely tax-free. For someone in the highest tax brackets, this could translate to savings of over $100,000 on a single home sale. Billionaires take this exclusion and supercharge it by strategically designating which of their multiple properties counts as their primary residence during different time periods. By carefully timing their moves and property sales, they can apply this exclusion repeatedly over their lifetime, potentially sheltering millions in real estate gains from taxes. What makes these 3 advantages so powerful isn't just using them individually. It's how they work together to create a tax-minimizing ecosystem. Imagine taking the mortgage interest deduction today, while your investments grow tax-deferred instead of paying off your mortgage, and then eventually selling your home with up to $500,000 in tax-free gains. That's 3 separate tax benefits from a single financial decision to maintain a mortgage. But the ultra-wealthy don't stop there. They layer on additional strategies like charitable remainder trusts to create even more tax efficiency. These sophisticated trust structures allow you to place appreciated assets into a trust, avoid capital gains taxes when selling those assets, and receive a charitable deduction for the present value of the future donation, all while still receiving income from the trust. This combination of strategies creates a virtually impenetrable tax shield around a billionaire's mortgage strategy. While they're borrowing against properties at favorable rates, they're simultaneously reducing their current tax bill, deferring taxes on investments, eliminating future capital gains, and generating charitable deductions. The most frustrating part for average Americans is that most financial advisors never explain how these strategies work together. They might mention the mortgage interest deduction, but rarely do they outline how maintaining a mortgage fits into a comprehensive tax optimization strategy. Instead, many still push the outdated advice to pay off your mortgage as quickly as possible without considering the tax implications. For example, imagine 2 homeowners with identical $500,000 mortgages at 4% interest. The first follows conventional wisdom and puts an extra $1,000 toward principal each month to pay off the mortgage early. The second maintains the regular payment schedule and invests that extra $1,000 in a diversified portfolio. After 15 years, the first homeowner has a fully paid home but no additional investments. The second still has a mortgage balance around $250,000 but also has an investment account worth approximately $300,000, assuming 7% average returns. If both sell their homes with the same $200,000 appreciation, the second homeowner comes out roughly $250,000 ahead when you factor in the tax benefits and investment growth, all while maintaining the exact same monthly cash outflow. Financial experts emphasize that understanding these tax advantages isn't just for the ultra-wealthy. The mortgage interest deduction may be less relevant for many homeowners now due to the higher standard deduction, but the principles of tax deferral and capital gains exclusion still apply regardless of income level. The key is evaluating whether itemizing makes sense based on your individual financial situation. What's particularly interesting is how the tax code essentially encourages leverage through these benefits. By offering multiple tax advantages to mortgage holders, the system is practically begging you to maintain strategic debt rather than paying it off. This runs contrary to conventional financial wisdom, but aligns perfectly with how billionaires approach wealth building. Consider this. Would the tax code include so many benefits for mortgage holders if the government genuinely wanted everyone to pay off their homes quickly? Probably not. These incentives exist because they serve economic purposes, encouraging home ownership, keeping capital flowing through investment markets, and stimulating economic activity. The wealthy see these incentives for what they are, an invitation to play the game by its actual rules, not by the simplified rulebook most Americans follow. They're not breaking any laws or exploiting loopholes. They're simply utilizing the tax code as it was designed, maximizing every advantage available to them. So what does this mean for you? Even if you're not managing billions, you can still implement scaled-down versions of these strategies. Start by questioning the conventional wisdom about rushing to pay off your mortgage. Consider whether itemizing deductions makes sense in your situation. Explore investment options for any extra cash you might have been putting toward additional mortgage payments. And most importantly, mortgage math. Make sure you understand paying off your home early is actually a bad move before selling your home. That extra mortgage payment you're so proud of making every month, it might be secretly sabotaging your financial future. While it feels good emotionally to chip away at your mortgage debt, the cold, hard numbers tell a completely different story that most Americans never see until it's too late. Let's be honest. We've all heard the conventional wisdom from financial gurus. They preach the gospel of debt freedom, telling us to throw every spare dollar at our mortgage principal. The reasoning sounds logical. Pay off your home faster, save on interest, and enjoy the peace of mind that comes with outright ownership. It's advice that's been passed down for generations. But here's the financial plot twist that changes everything. The math simply doesn't support this approach. And it's not even close. Let me walk you through a real-world example that might completely change how you think about your mortgage. Imagine you have an extra $100,000, maybe from an inheritance, a bonus, or years of diligent saving. You're faced with two options. Make an extra payment toward your mortgage principal or invest that money in a simple S&P 500 index fund. If you choose to put that $100,000 toward your mortgage with a 4% interest rate, you'd save approximately $120,000 in interest over the remainder of your loan. That's not insignificant. You'd pay off your loan years earlier and potentially save six figures. On the surface, this looks like a win. But what if you invested that same $100,000 in an S&P 500 index fund instead? Assuming a conservative 8% average annual return, which is actually below the historical average, that $100,000 would grow to over $1 million after 30 years. That's a difference of more than $880,000 in favor of keeping your mortgage and investing instead. Let that sink in for a moment. The opportunity cost of paying off your mortgage early isn't just the interest you save. It's the much larger potential growth you sacrifice by not investing that money. This isn't just theoretical. This mathematical reality is precisely why wealthy individuals rarely rush to pay off their mortgages. They understand that mortgage debt, especially at today's relatively low rates, is among the cheapest money you'll ever borrow. While you're focused on saving thousands in interest, they're using that same strategy to potentially make millions. Many people mistakenly think that paying off debt and investing are equally valid financial goals. But they're not playing the same game. Debt elimination is about avoiding losses, while investing is about creating gains. And the potential gains from investing typically far outweigh the losses you'd avoid by paying down low-interest debt. Think about it from another angle. If a financial advisor told you they had a guaranteed investment that would return 4%, your mortgage interest rate, but right next to it was another investment with a strong likelihood of returning 8%, which would you choose? When framed this way, the answer becomes obvious. But why do so many people still prioritize paying off their mortgage early? Research in behavioral finance provides some fascinating insights. Studies suggest that many individuals prefer to pay off their mortgages due to a psychological aversion to debt, despite the mathematical advantages of investing. This mindset is deeply ingrained and often reinforced by societal beliefs that equate debt with financial failure. There's an emotional comfort that comes with debt elimination that's hard to quantify. People sleep better at night, knowing they own their home outright. But that peace of mind comes at a steep price tag, potentially hundreds of thousands or even millions in lost wealth over a lifetime. Let's look at another practical example. Say you have an extra $500 every month that you could either add to your mortgage payment or invest. Over a 30-year mortgage, That extra $500 monthly would shave years off your loan and save you a substantial amount in interest. However, if you invested that $500 monthly in an index fund instead, you'd likely end up with significantly more money, often 2 to 3 times what you'd save in mortgage interest. Financial advisors who focus on wealth building rather than debt elimination consistently point out this mathematical reality. They emphasize that maintaining a mortgage while investing can lead to greater wealth accumulation over time. Plus, the interest on a mortgage is often tax-deductible for those who itemize, which can further enhance the financial benefits of keeping a mortgage rather than paying it off early. Inflation adds another dimension to this equation. When you have a fixed-rate mortgage, inflation actually works in your favor as a borrower. As inflation rises, the real value of your mortgage debt decreases, meaning you're paying back your loan with less valuable dollars over time. During periods of high inflation, like we've seen recently, this effect becomes even more pronounced. I'm not suggesting you should never pay off your mortgage early. There are legitimate scenarios where it makes sense, particularly as you approach retirement and want to reduce monthly expenses, or if you're exceptionally debt-averse and the emotional benefits outweigh the mathematical disadvantages. But for most people in their wealth-building years, prioritizing mortgage prepayment over investing is a costly financial mistake. The math is clear. The opportunity cost is simply too high. Some skeptics might point out that investment returns aren't guaranteed, while the interest savings from paying down your mortgage are. That's true. The stock market doesn't go up in a straight line. However, over long time horizons, 15 to 30 years, the historical data overwhelmingly supports the investment approach. Time in the market smooths out the volatility, and patient investors have been rewarded. There are also middle ground approaches. Many successful investors maintain their mortgages, but establish substantial emergency funds and diversified investment portfolios. Some even use home equity lines of credit, HELOCs, to finance investments in real estate or the stock market, leveraging their existing home equity for greater returns. This strategy requires discipline and risk management, but it illustrates how strategic borrowing can accelerate wealth building. The takeaway isn't that you should necessarily maximize your mortgage debt, but rather that you should be intentional about where each dollar goes based on its highest potential use. Every dollar has an opportunity cost, and understanding that cost is essential to making optimal financial decisions. For many Americans, the biggest financial mistake isn't taking on a mortgage. It's rushing to pay it off while neglecting investments. The wealth gap between those who understand this principle and those who don't grows exponentially over decades. Think of your mortgage not as a burden to eliminate at all costs, but as a potentially valuable financial tool that, when used strategically, can help accelerate your path to financial independence. Your goal shouldn't necessarily be to be debt-free as quickly as possible, but rather to build the highest possible net worth over time. This perspective shift, from debt elimination to wealth optimization, is the same one that guides the financial decisions of billionaires. They don't avoid debt entirely. They leverage strategic, low-cost debt as part of a comprehensive wealth-building strategy. The mortgage math doesn't lie. By keeping your mortgage and investing the difference, you're positioning yourself to potentially accumulate hundreds of thousands or even millions more over your lifetime than you would by aggressively paying down your mortgage. Your future self might thank you for understanding this critical financial principle that so many miss. Good debt versus bad debt, reframing how you think about borrowing. This fundamental mindset shift that separates billionaires from everyone else when it comes to debt isn't complicated. It's simply about classification. While most financial advice lumps all debt together as this evil burden to eliminate, the ultra-wealthy see it completely differently. The wealthiest people on the planet have rewritten the rules of borrowing by categorizing debt based on what it actually does for their financial future. This perspective flip changes everything about how they approach their finances. You've probably been told since childhood that debt is something to avoid at all costs. Parents, teachers, and even mainstream financial gurus preach the gospel of debt elimination as the cornerstone of financial success. Pay off your credit cards, drive a used car with cash, be debt-free as quickly as possible. Sound familiar? But here's something fascinating. Billionaires completely reject this oversimplified view. Instead, they've developed a sophisticated mental framework that divides debt into two distinct categories: good debt and bad debt. Bad debt is money borrowed for things that drop in value or get consumed quickly. Think credit card balances carrying 18% interest for that vacation you took last year, car loans for vehicles that depreciate the moment you drive off the lot, or high-interest personal loans that fund lifestyle expenses with nothing to show for it afterward. This category of borrowing truly can be destructive to wealth building. And yes, billionaires avoid this kind of debt like the plague. But good debt, that's an entirely different animal. This category includes borrowing for assets that gain value over time or generate income that exceeds the cost of the loan. Mortgages on appreciating real estate, business loans that fund profitable ventures, or margin loans that allow for strategic investment opportunities. The wealthy don't just tolerate good debt, they actively seek it out as a wealth amplification tool. What makes this categorization so powerful is that it completely shifts your decision-making. Instead of asking, should I go into debt, which frames all borrowing as negative, billionaires ask, what will this borrowed money help me acquire? This simple reframing focuses attention where it belongs, on the purpose and outcome of the borrowing rather than the act itself. Psychological studies reveal something fascinating. Attitudes toward debt vary dramatically across wealth levels. Those with higher net worth consistently view certain types of debt as strategic tools for leverage, while those with less financial security often view all debt as a burden to escape. This isn't just about having more money. It's about a completely different relationship with the concept of borrowing. Consider how different cultures approach debt. In some countries, strategic borrowing is viewed as a necessary part of financial growth and wealth building. In others, there's such a strong cultural stigma against any form of debt that people miss tremendous opportunities for financial advancement. These deeply ingrained attitudes shape financial futures more powerfully than most realize. The historical perspective adds another interesting layer. Back in the early 20th century, debt was often seen as a necessary component of economic growth and development. The Great Depression shifted public sentiment dramatically, creating a much more cautious approach to borrowing that still influences many people's thinking today. But the ultra-wealthy have moved beyond these emotional reactions to develop a more nuanced view. Good debt creates something magical in your financial life: leverage. This concept is like having a financial superpower, using other people's money to control more assets than you could with just your own capital. When you put down $200,000 on $1 million investment property, and the bank provides the other $800,000, you now control $1 million asset while only committing a fraction of your own resources. If that property appreciates 5% in a year, you've gained $50,000 on your $200,000 investment, a 25% return. This leverage principle scales up dramatically with billionaires. They might control billions in assets while having only a fraction of that amount in actual equity. The rest is strategic good debt, carefully structured to maximize their control of appreciating assets while minimizing their personal capital commitment. The interest expense becomes just another business cost, often tax-deductible, and a small price to pay for the wealth-building potential that leverage provides. It's a completely different paradigm from the average household struggling to get out of credit card debt. Interestingly, the wealthy focus intensely on the purpose of debt rather than simply avoiding it. They constantly ask themselves, what will this borrowed money help me acquire? This question forces them to evaluate borrowing based on its potential return rather than some oversimplified rule about all debt being bad. When a billionaire takes on a mortgage for a new property, they're not thinking, I need to pay this off as quickly as possible. Instead, they're calculating how that borrowed capital could potentially perform elsewhere. If the interest rate is 4%, but they expect their investments to return 8 to 10%, keeping that mortgage actually accelerates their wealth building over time. This strategic approach to debt extends beyond just real estate. Wealthy entrepreneurs regularly use business loans to fuel expansion rather than depleting their existing capital. They understand that maintaining liquidity and flexibility often provides more long-term advantage than being completely debt-free. The concept of opportunity cost sits at the heart of this philosophy. Every dollar used to pay down low-interest good debt is a dollar that can't be invested elsewhere at potentially higher returns. The wealthy are constantly evaluating the highest and best use of their capital, and often, that isn't rapid debt repayment. Consider the education example. Student loans for degrees that significantly increase earning potential can be considered good debt, especially when interest rates are reasonable. The education itself is an appreciating asset that generates returns through higher income over decades. Meanwhile, borrowing for education with poor employment prospects and sky-high interest rates looks more like bad debt. Even the way the wealthy structure their debt differs dramatically from average consumers. They negotiate aggressively for more favorable terms, focusing on interest rates, tax advantages, and flexibility rather than just the monthly payment. Many secure interest-only payment options that maximize their cash flow while maintaining the tax benefits of the loan. There's a striking difference between how the average homeowner views their mortgage and how a billionaire sees the same financial instrument. The average person counts the years until they're free of their mortgage, while the billionaire strategizes how to optimize the terms of their loans to maximize wealth-building potential. The wealthy maintain this classification system as they make financial decisions throughout their lives. They ruthlessly avoid bad debt that finances consumption or depreciating assets, while strategically embracing good debt that helps them acquire assets that appreciate or generate income beyond the cost of borrowing. This isn't just theoretical. It's precisely how the billionaires we've examined structured their finances. They use mortgages strategically, not because they lack the cash to pay for properties outright, but because they've calculated that borrowed money deployed elsewhere will generate greater wealth over time. For those of us who aren't billionaires, this mental framework remains equally valuable. Rather than viewing all debt through the same simplified lens, we can begin evaluating borrowing opportunities based on purpose and potential. Is this loan helping me acquire something that will likely gain value or generate income greater than the interest cost? If yes, it might be good debt worth considering. If not, it's probably bad debt to avoid. What's truly powerful about this mental shift is that it changes how we perceive our existing debts. That student loan might actually be good debt if it substantially increased your earning potential. Your mortgage could be wealth-building good debt if it's at a reasonable interest rate and the property is in an appreciating area. Conversely, those credit card balances from impulse purchases definitely count as bad debt to eliminate. The biggest breakthrough in thinking like a billionaire comes when you stop seeing debt as inherently good or bad, and instead evaluate each borrowing opportunity based on its specific purpose and potential. This nuanced approach transforms debt from a scary burden into a potential tool for building wealth, but only when used strategically and selectively. Your Billionaire Mortgage Playbook, 5 strategies anyone can use. That mental shift from seeing debt as strategic rather than scary is powerful. But how exactly do you put it into practice? Contrary to what financial gurus preach, billionaires aren't racing to burn their mortgage papers in celebratory, debt-free ceremonies. Instead, they implement 5 specific mortgage strategies that actually accelerate wealth building. And the good news is you don't need billions to use them. Let's bring these billionaire tactics down to earth with practical steps anyone can apply, regardless of your bank balance. The reason most people never implement these strategies isn't that they're complex. They're actually surprisingly simple. The real barrier is that they contradict everything we've been taught about responsible money management. Strategy number 1, minimize your down payment, within reason, to keep more capital invested elsewhere. When most people buy a home, they scramble to put down as much as possible, 20%, 30%, sometimes even 50% of the purchase price. But look at what the ultra-wealthy do instead. They put down just enough to secure favorable loan terms while keeping their capital working in higher return investments. This doesn't mean going with the absolute minimum down payment, which can trigger PMI, private mortgage insurance, and higher interest rates. The sweet spot is typically 20%, enough to avoid PMI while maintaining healthy cash reserves for other investments. Let's see this in action. Imagine you're buying a $500,000 home. You could put down $200,000, 40%, or stick with $100,000, 20%. That extra $100,000 kept invested in a diversified portfolio, earning a modest 7% annual return, would grow to over $196,000 in just 10 years, nearly doubling your money while still building equity in your home. This strategy works because historically, diversified investments have outperformed real estate when comparing rates of return. By keeping more of your money invested outside of your home, you're positioning yourself for potentially greater overall wealth growth. Strategy number 2, choose the longest mortgage term available to maximize your financial flexibility. When most homebuyers are deciding between a 15-year or 30-year mortgage, they focus solely on the total interest paid and rush to choose the shorter term. Billionaires take the opposite approach. They select the longest available term, even when they could easily afford shorter ones. Why? A longer mortgage term creates breathing room in your monthly budget. The difference between a 15-year and 30-year payment on a $400,000 mortgage could easily be $1,000 per month. That's an extra $12,000 annually you could direct toward investments, business opportunities, or simply maintaining financial flexibility for unexpected challenges or opportunities. This approach is particularly powerful during inflationary periods. When you lock in a fixed-rate 30-year mortgage, you're essentially agreeing to pay back the loan with dollars that will be worth significantly less in the future. While everyone else feels the squeeze of rising prices, your fixed housing payment remains constant, creating an increasingly favorable financial position over time. Strategy number 3. Consider an interest-only mortgage if you're disciplined about investing the difference. Here's where things get interesting. Interest-only mortgages have gained a negative reputation after the 2008 housing crisis, but the ultra-wealthy continue to use them as sophisticated wealth-building tools. With this loan type, you pay only the interest portion for an initial period, typically 5 to 10 years, resulting in significantly lower monthly payments. The key distinction between how average borrowers and billionaires use these mortgages is what happens with the money saved. If you pay interest only but spend the savings on depreciating assets or lifestyle inflation, you're digging yourself into a hole. But if you consistently invest those savings in assets that outperform your mortgage rate, you can come out substantially ahead. For example, on a $500,000 mortgage at 4% interest, an interest-only payment would be about $1,667 monthly, while a principal and interest payment on a 30-year loan would be around $2,387. That's a $720 monthly difference that, invested at 7% for 10 years, would grow to approximately $120,000, all while maintaining your ownership position in a potentially appreciating home. This strategy requires discipline and commitment to actually investing the difference rather than spending it. It's not for everyone, but for financially disciplined individuals, it can significantly accelerate wealth building. Strategy number 4, refinance when rates drop, but keep the loan term the same rather than shortening it. When interest rates fall, most homeowners make a critical mistake when refinancing. They restart with a fresh 30-year term, but then immediately shorten it to pay off their home faster. The wealthy take a different approach. They refinance to capture lower rates, but maintain their original loan timeframe to preserve cash flow and investment potential. Let's say you're 5 years into a 30-year mortgage and rates drop significantly. Instead of refinancing into a new 30-year loan and then making higher payments to stay on schedule, consider refinancing for the remaining 25 years at the lower rate. This maintains your debt payoff timeline while reducing your required monthly payment, creating more financial flexibility. The savings from a lower interest rate can be substantial. A 1% reduction on a $400,000 mortgage could save roughly $4,000 annually in interest. Rather than applying that savings to pay your mortgage faster, direct it toward retirement accounts, investment properties, or other growth opportunities that could yield much higher returns over time. This strategy preserves your original payoff date while maximizing the cash flow benefits of lower interest rates, essentially giving you the best of both worlds. Strategy number 5. Instead of making extra principal payments, redirect that money to tax-advantaged investments. Perhaps the most counterintuitive strategy of all is resisting the urge to make additional principal payments on your mortgage. Financial gurus constantly encourage homeowners to make bi-weekly payments or add extra to their monthly payment to save on interest and pay off their homes early. The wealthy take a completely different approach. Rather than making extra mortgage payments, they funnel that money into tax-advantaged accounts like 401k, IRAs, HSAs, and 529 plans. Investments that provide immediate tax benefits and potential growth that significantly outpaces their mortgage interest rate. Consider this comparison. If you have a 4% mortgage, every extra dollar you put toward principal saves you 4% in interest. But if you're in the 24% tax bracket and contribute to a tax-deferred retirement account, you immediately earn a 24% return through tax savings plus whatever market returns your investments generate over time. The math becomes even more compelling when employer matches are involved. If your employer offers a 50% match on retirement contributions, you're immediately getting a 50% return on investment before any market growth, dramatically outperforming what you'd save by paying down mortgage debt early. While these strategies may feel uncomfortable if you've been conditioned to view all debt as negative, the financial results speak for themselves. The real risk isn't maintaining strategic mortgage debt. It's missing out on decades of potential investment growth by overpaying your mortgage. Of course, these approaches come with certain cautions. Market volatility means investment returns aren't guaranteed, and these strategies work best for those with solid emergency funds and stable income sources. Your age, risk tolerance, and overall financial situation should always influence which strategies make sense for your specific circumstances. The most crucial step is assessing your personal financial situation. Are you maximizing retirement contributions? Do you have adequate emergency savings? Is your investment strategy aligned with your goals? These fundamentals must be in place before implementing more advanced mortgage strategies. What's the secret sauce behind billionaire wealth? According to Warren Buffett, it's not just about avoiding debt. It's about using it as a powerful tool. As Buffett puts it, a home should be the greatest asset for most people, and he strongly advocates leveraging mortgage debt for investment purposes. The ultra-wealthy don't obsess over getting debt-free. They reframe debt as a strategic weapon in their financial arsenal. This psychological shift from viewing debt as a burden to seeing it as an opportunity creates dramatically different financial outcomes. Look at the data. Ultra-high net worth individuals consistently finance their homes rather than paying cash, allowing their capital to work harder elsewhere. And this trend is growing. The number of ultra-wealthy individuals is projected to increase by 28% by 2028. The real wealth-building secret isn't avoiding mortgages. It's understanding that money's true cost isn't measured by interest rates, but by opportunity cost. Start asking yourself not, how quickly can I pay off this debt? But, how can this strategic borrowing multiply my wealth?